What if your money didn't have to stay in just one country, but could grow across the world? International markets open the door to global companies, new economies, and powerful growth opportunities. But here's the truth. Global investing can build wealth faster or expose you to unexpected risks if you don't understand it. In this video, I'll show you how to invest in international markets safely and what every beginner must know before starting. Investing in international markets means putting your money into companies, funds, or assets outside your home country. In 2026, this has become much easier due to global brokerage platforms, fractional investing, and digital access to stock exchanges worldwide. However, while global investing can significantly increase diversification and returns, it also introduces unique risks that must be carefully managed. What is international investing? International investing refers to buying financial assets such as stocks, ETFs, bonds, or mutual funds listed in foreign markets. For example, an investor in Pakistan or India may invest in U.S. companies like Apple or Amazon, European stocks, or emerging Asian markets. This is typically done through global brokerage accounts, international ETFs traded, mutual funds with global exposure, ADRs, American depository receipts. The goal is simple: reduce dependency on a single economy and capture global growth opportunities. Why global investing matters in 2026. The global financial system in 2026 is highly interconnected. A slowdown in one region can impact supply chains worldwide, while technological breakthroughs in another region can create massive global opportunities. This interconnectedness creates two important realities. First, no single country dominates every sector. For example, one country may lead in technology, another in manufacturing, and another in energy resources. By investing globally, you're effectively buying exposure to multiple growth engines of the world economy. Second, economic cycles are not synchronized. When one market is in recession, another may be expanding. This cycle difference creates opportunities for risk balancing and return optimization. Major benefits of international investing. One of the strongest advantages is true portfolio diversification. Domestic markets are often influenced by local political decisions, inflation rates, and economic policies. By expanding globally, investors reduce dependency on a single economic system. This reduces single country risk, which is one of the biggest hidden risks in investing. Another major benefit is access to global innovation leaders. Many of the world's most valuable companies operate in specific regions. By investing internationally, you gain exposure to industries like artificial intelligence, advanced robotics, biotechnology, electric vehicles, and semiconductor manufacturing at a global scale. International investing also helps with currency diversification. If your domestic currency weakens due to inflation or economic instability, investments in stronger currencies can preserve purchasing power. Over long periods, this can significantly impact real returns. Additionally, global markets provide sector exposure that may not exist locally. Some countries specialize in industries like luxury goods, advanced pharmaceuticals, or financial technology. By investing internationally, you are not limited by your local market structure. Finally, international investing often increases long-term return stability. While individual markets may experience downturns, a globally diversified portfolio tends to smooth volatility over time. Risks of international investing: deep analysis. Despite its advantages, international investing introduces multiple layers of risk that are not always obvious to beginners. The most important is currency risk, also called exchange rate risk. When you invest in a foreign asset, your returns depend on both the performance of the investment and the currency exchange rate. Even if a stock increases in value, a weakening foreign currency can reduce your actual return when converted back into your local currency. There is also regulatory and legal risk. Each country has its own financial system, tax rules, and investor protections. Some markets may have strong transparency and regulation, while others may have weaker enforcement or limited investor safeguards. Liquidity risk is another concern, particularly in smaller markets. In less developed exchanges, it may be difficult to buy or sell large positions without affecting market prices. Finally, market correlation risk must be considered. During global crises, markets often move together, meaning diversification benefits can temporarily decrease when they are needed most. Safe strategies for international investing. A safe global investing approach begins with diversification at multiple levels: country diversification, sector diversification, and asset class diversification. Instead of focusing on one region or industry, investors should spread capital across different economic environments. One of the safest entry methods is using global ETFs, traded funds. These funds automatically invest in a basket of international companies, reducing the risk of selecting individual stocks. For beginners, this is often the most efficient and stable approach to global exposure. Another important strategy is gradual capital allocation, also known as dollar cost averaging. Instead of investing a large amount at once, investors allocate funds over time. This reduces the risk of entering the market at a peak price. Using regulated international brokers is essential. Investors should only use platforms that comply with financial regulations, offer transparent reporting, and provide strong security measures for cross-border investments. A long-term mindset is critical. International markets can be volatile in the short term due to political events or economic shocks, but historically, diversified global investing has rewarded patient investors over time. Advanced perspective, portfolio construction. Professional investors often think in terms of global asset allocation models. Instead of choosing individual countries emotionally, they allocate percentages based on global GDP weight, market capitalization, or risk-adjusted return expectations. Institutional investors also rebalance portfolios periodically to maintain target allocations. This ensures that no single market becomes overweight due to short-term performance spikes. Now you understand how international investing works, the benefits, the risks, and how to approach it safely. The key is simple: diversify smartly, stay informed, and invest with patience instead of emotion. If you found this helpful, don't forget to like this video and hit the subscribe button for more clear, practical investing guides. Your global wealth journey starts with one smart decision: keep learning and stay consistent.